Well, we're back to pick up our conversation with Tom Lydon. He's editor and publisher of ETF Trends, and today we're going to focus on innovation within indexing and ETFs. Well, thanks for being back with us, Tom.
Great. I appreciate it. Thanks for the invitation, Shaun.
Well, two other areas that we need to talk about from an innovation standpoint. Fixed income from the standpoint of ETFs, and then a little bit more into factors. So if we could start with fixed income, how do you think that's changing the way that advisors are building portfolios?
Well, first of all, you look at the benchmark, which tends to be the Barclays Agg. You know, most advisors look at the Barclays Agg and say, well, I need to be somewhere in line there. Most don't understand that the Barclays Agg has changed a lot since the end of the financial crisis. The duration has doubled and the credit quality has decreased.
Right.
So there's a lot more risk there. And we're at the end of a 30-year bull market in bonds. So there's tons of opportunity for advisors to, number one, understand what the Barclays Agg is all about, and also carve out those areas that might be too risky. Definitely treasuries, long treasuries, are more susceptible in a rising rate environment. But you can diversify in other areas. There's some smart beta strategies that have, in fact, low duration or even negative duration when you can diversify in certain areas too. Going outside the U.S., emerging market bonds, for example, are very fairly priced, but with offering great yield. So I think with these types of different strategies that really weren't available to advisors before, especially the last time we had a rising rate environment, if you do your work, you can do a better job for your client rather than just sticking to the Barclays Agg.
Right, that makes a lot of sense. Now, with regard to factors, our view is that factors are an innovative outcropping from the smart beta start, which could be noise, there could be something to it. Yeah. If factors are to be meaningful, again, it has to be something that advisors are finding ways to use. So how are you seeing advisors implement, or how are you seeing them evaluate factor-based exposures?
Well, first of all, they're very compelling. If you just take fundamental strategies alone, which tended to be coming on to in the ETF space first. But if you look back to find out when it in fact provided that added kick, it wasn't that it provided an alpha at a certain point in time. It's the fact that during the last financial crisis, it wasn't jacked up in technology stocks, for example, or financial stocks. It in fact had a low allocation there, and sure enough, after the financial crisis, when valuations in those areas were in line and very attractive, it loaded back in. That's what that discipline of factor investing does. So we've actually, while we've seen almost $500 billion go into factor or smart beta strategies, there's very few that have outperformed the S&P 500, so a lot of people are scratching their heads and saying, geez, are they really going to get the traction or have that alpha? But you know what? A bull market can do a lot to be able to provide that opportunity for alpha, and I think we'll see that.
Well, that is a good point. I mean, as we've looked at factors and their performance over periods of history, they have their times when they outperform, almost like the seasonality of sectors. Do you think that advisors are really starting to see that it's not so much that these factors can be held long necessarily, that maybe they need to be more dynamic in their use?
Well, now is the time, right? Because when we have some PEs that are touching 20, you've got some factor strategies where there's valuations that are very, very fair based on certain disciplines, great. Dividend-oriented strategies where there's risk on the fixed income side, you can actually pare down your fixed income allocation and get some of that income on the dividend side. So there's great innovation that's going on there. Are there too many smart beta or factor strategies? I don't know. I mean, it'll all come out in the wash. The great thing is there's good competition with good companies, and with all the choice and the pressure on pricing, who ends up winning in the end? It's the advisor and the individual investor.
Right. So as we start to wind down a little bit, are you up for a couple rapid fire questions?
Sure, hit me.
ETF strategists, where do you stand on them?
Yeah, I again, like cycles in the marketplace, they are definitely worth what they're paid because they've done a great job over time. But in an ongoing bull market in stocks, it's been really difficult for strategists to beat the market. Yeah. Will that happen during times of correction? Will they have disciplines that will take something off the table to maybe keep some of the powder dry in the next decline. I think a lot of them will, and that will end up increasing their long-term track records. So they're well worth it. And most importantly, for advisors who love ETFs, but you don't have the bench to do all the research, you can partner with strategists or multiple strategists to make sure your portfolio construction is right for your clients.
That's a great point, and kind of segues into the next one. You see a lot of robo-advisors out there using ETFs and putting together portfolios. What do you think about Robos, and what do you think about advisors working with Robos?
Yeah, again, the competition has been great because you can basically put your wrapper around a robo-advisor for next to nothing. So it's easy to get into the space. And when we talk about millennials again, what does that generation look for? They're going to want to look at their portfolio on their phone. They want ETFs, and they're going to want it really, really simple. So to be able to add a robo offering to a successful advisory firm is really, really easy. There are also some older folks like us that might say, yeah, I'd like to have some in a robo account. So it's just more choice and more access. And so it's good, and it's going to continue to grow in popularity over time.
Yeah. So we have the two largest ETF issuers and some on the sides, basically in a price competition. What do you think about that?
Yeah, we're not that far away from being able to buy ETFs and pay no expense ratio. That's coming, and we know that that's coming fast, right? So it's all about the asset grab. We benefit from that, and our clients benefit from that, which is fantastic. It's going to be tougher and tougher for new entrants into the ETF space for sure, but we're seeing more and more big names come in. So from a price standpoint, and we're seeing, geez, all this money that's flowing into core products that are 4 or 5 basis points, again, getting back to the subject of the top 100 ETFs, that's going to do nothing but continue to grow. So pricing is absolutely the #1 driver for advisors today as far as their decisions on where they're allocating. They are rounding out into some other factor strategies and even some more creative strategies as well. Alternative strategies, commodities that 10 years ago was really difficult to get access to. So it's all about choice, and the more choice and the less expensive those choices are, the end client ends up winning.
Right. Well, you've kind of led me to where I wanted to close with you is, where do you see the biggest trend coming up within ETFs?
Yeah. So still, mutual funds are $15 trillion. We're at almost $3 trillion with ETFs. So we have a long way to go. There's a lot. there are a lot of expensive, poor-performing mutual funds out there that days are numbered. They continue to see redemptions, and that naturally should happen. #1. #2. 401ks, we still haven't found our way in there yet.
Yeah.
There'll eventually be enough pressure so they'll have to cave.
Some new plumbing is needed.
Absolutely. I mean, Fidelity, 3/4 of every new dollar that goes into Fidelity funds goes in via 401k plans. And they have some great offerings in the funds. But eventually we're going to see low-priced ETF offerings in 401k plans. And part of that is this momentum that we've already seen with DOL and the fiduciary rule. It's being delayed, but the momentum's already in place.
Right.
Everybody's talking about it.
You've seen Morgan Stanley go there. You've seen Merrill Lynch go there. There is just a lot of momentum in that direction.
If you're an advisor and you're not preparing for that, this is the warning. Get going because it's coming.
Yeah. Well, Tom, thank you so much. It's always a pleasure to speak with you.
Great seeing you, Shaun. Thank you.
Absolutely. For those of you who'd like to learn more about how indexing works for advisors, please visit our website. That's spdji.com. Thanks, and have a great day.